In today's Smart Money, we want to talk about investments. Sam DeGreen is an investment advisor with DeGreen Capital Management, and he's here to tell us why we should avoid the pitfalls of gold. Good to see you again, Sam. Okay, so why do people buy gold?
Yeah, okay, so people buy, there are two primary emotions that drive markets. That is fear and greed. Now, gold applies to fear. And they're concerned, people who buy gold are usually concerned about markets collapsing. As the election comes on, people start to get worried. And gold really appeals to a sense of uncertainty, and it makes people feel better. But it is probably, in my opinion, one of the worst investments that one can make. In fact, I would just call it a shiny metal paperweight. It's not an investment at all.
Wow, when I knew I was going to do this story, I was so shocked to hear you take this stance about gold. Why do you think it's a poor investment?
Well, it's not a popular stance, but it's the right stance. So the reason is gold is an inanimate object. It is a rock, to put it simply. It produces no value. It provides no stream of income. It gives no money at all. It is purely a speculative vehicle. It is worth what the next person is willing to pay for it. That's it. It does make you feel safe. We've all held the gold bars. They're fun. But in general, an investor would be better off buying a diversified, low-cost portfolio of stocks and bonds. And I get it. It feels good. I get it. It feels good. But gold, on the other hand, you can't value it because it doesn't produce anything. And so that would make it a speculative vehicle.
And so many people, I know you know this, they invest in gold as an inflation hedge. So basically they feel like, you know what, the US dollar can lose value all at once. My gold is going to gain value, but you say that's not necessarily the case.
That's absolutely, it's absolutely true. And you often hear that phrase that gold is a hedge against inflation. You hear it on the commercials, except study after study after study has proven time and time again that it's not. Number one, it's just way too volatile to be an inflation hedge. It needs some stability in order to be an inflation hedge. For example, in 1980 to 2001, gold lost 70% of its value. That doesn't sound like an inflation hedge at all. If you want an inflation hedge, you buy something called a treasury inflation protected security. This is indexed to inflation. That will protect your money if you're worried simply about inflation.
So how do you recommend people go about investing?
Sure. So the first thing we always say is that before you choose any security or any portfolio, you got to meet with an advisor. You want to make sure that the investment that you choose is suitable for you, that it feels right for you, and that you're comfortable with the amount of volatility that you are going to inevitably face. And that will happen. You will inevitably face volatility. And you have to think, what are my investment objectives? Are they income? Are they growth? Are they both? You have to really consider that. But gold doesn't provide income, and it's not necessarily always going to provide the growth people think it is.
All right. Well, Sam, great information. Again, you took a strong stand and you supported it. Let's give you some information. If you would like to contact Sam, the DeGreen Capital Management office is located at 4800 North Scottsdale Road, Suite 1800. You can also listen to him on News Talk 550 KFYI Saturdays from 11 a.m. to 1. Give him a call, 480-609-9900, or log on to degreen.com.